Welcome to the Roy Morgan Weekly Update, and it seems all eyes are on the Middle East. Although the Israeli strike on Iran and the Iranian response occurred late last week, they may already be having an impact on the Roy Morgan key weekly indicators, including consumer confidence and inflation expectations, with both indicators moving in a negative direction, and the Australian workforce contracting. Around a fifth of both oil and gas is traded through the Persian Gulf, and these key exports for the global economy are at risk from any conflict in the region. If the conflict continues to escalate and potentially threaten the global energy supply, with a potential spike in prices for key commodities like oil and gas, it will have a devastating impact on global markets worldwide. And at home, the impact could be inflationary, which could in turn prevent the Reserve Bank from cutting interest rates in early July, as is widely expected. So how are we consumers feeling? The answer is less confident. The latest ANZ Roy Morgan Consumer Confidence, based on interviews conducted throughout the last week, dropped 1.3 points to 85.4, perhaps already impacted by the tensions in the Middle East. This is the lowest consumer confidence rating for 7 weeks since late April, before the comprehensive election victory for the Albanese government. Driving this consumer confidence lower was increasing concern about people's personal finances over the next 12 months. Now, 34% of Australians expect to be worse off financially this time next year. That's up 4 percentage points on just a week ago. And it's the highest rating for this indicator so far this year. Now, when consumer confidence falls, ANZ Roy Morgan inflation expectations tend to move in the opposite direction, and this week is no different. Inflation expectations increased 0.2% to 4.9%. Australians now expect inflation of 4.9% over each of the next 2 years, a figure just above the long-term average of 4.8% for this measure over the last 15 years. Now to employment and unemployment, the measures that really matter. Real unemployment in May is 10.9%. That's down 0.3% on a month ago. So an estimated 1.72 million Australians are unemployed. Now, the fall in unemployment is not the feel-good story you might think it is. The drop in unemployment was not because people looked for work and found jobs. It was due to people looking for work giving up and leaving the workforce. In fact, it's all about contraction in the Australian workforce. Roy Morgan estimates the workforce size, which adds together both the employed and unemployed people, at just over 15.7 million. 15,740,000 to be precise in May, and that's down 206,000 on a month. And it represents about 68.3% of Australians aged 14 plus. Now, this is the lowest workforce size for over 6 months, since October 2024. Key employment indicators fell in May, including full-time employment, part-time employment, and unemployment. Roy Morgan estimates just over 14 million people were employed in May, 14 million and 25,000 to be precise, and that's down 141,000 employed people from a month ago, and its lowest level of employment for over 18 months. It represents 60.8% of Australians aged 14 plus. The conclusion from these figures is a really concerning one, that employment growth has weakened and in fact gone backwards in recent months, with fewer people employed and some people choosing to leave the workforce rather than continuing to look for work. So looking forward, the re-elected Albanese government will need to prioritise getting the economy moving again, creating jobs and keeping people in the workforce. This is crucial for productivity. Overall, total unemployment and underemployment, what we call workforce underutilisation, was 20% of the workforce in May, estimated at over 3.1 million people. And this is the 6th straight month that unemployment and underemployment has been above 3 million. Now for something different. The Roy Morgan telecommunications industry team and our data scientists have been exploring the changing telecommunications market and have found the cost of living crunch has created opportunities for MVNOs. What's an MVNO, I hear you asking? Australia's mobile virtual network operators, the MVNOs, include brands like Aldi Mobile, Tangerine, Kogan, Dodo, Aussie Broadband, Coles Mobile, and Everyday Mobile from Woolworths. They're resellers who use the network bandwidth of one of the main players like Telstra, Optus, or TPG Telecom. And the latest Roy Morgan data shows the MVNOs, or resellers, are increasing their share of Australia's mobile phone market during a sustained cost of living crisis, and Australians are consistently recommending them to others. This creates an interesting dynamic. Although the majors still have their network used by the MVNOs, they lose direct contact with the customer, and therefore they lose the ability to build relationships and to cross-sell. This chart shows the MVNOs have increased their share of mobile phone services from 17% in the 6 months to March 2021 to 19% in the 6 months to March 2025. That's an increase of 700,000 to 4.3 million services. Interestingly, cheaper prices don't mean poorer customer service. The net promoter scores of MVNOs are consistently higher than those of their network owners. Overall, MVNOs have an average NPS of 33.5. Now, to put that into context, Telstra's NPS is 6, Optus is -5, and Vodafone is 1. And that's a wrap. Thanks for your interest in Roy Morgan's latest results. I'll be back next week to bring you the latest results on consumer confidence, inflation expectations following the escalation of the conflict in the Middle East, and the latest mortgage stress figures as we approach another Reserve Bank meeting in early July. Thanks for listening.